All right, welcome back to the Money Puzzle. I'm Chris Vaughn here with Eric Douglas, my partner once again. We got a special guest today. This is Heather McCormick from McCormick Advantage Insurance Company. Heather has been a good friend of our firm for a long, long time. There's a lot of clients that have gone back and forth between all of us to the point that Heather actually keeps her office right here in our office, which is why we wanted to bring her on today. We had really interesting conversation popped up the other day. Just one of those organic things that popped up, and Heather started pointing out what you called, I believe it was a tsunami, right?
A little bit.
She said the tsunami is coming, and Eric and I were like, well, what do you mean the tsunami is coming? So, kind of to tee this up a little bit, when we're putting together financial plans, one of the biggest holes that can happen, one of the things that can destroy a plan faster than anything else is not having the correct insurance. And then, having a car accident or something like that, maybe not even your own fault. It could be the other driver's fault, but you end up on the hook for hundreds of thousands in some cases of medical bills, damages, things like that, because you don't have the right insurance. So that's kind of what got that conversation started. So when we say when there's a tsunami coming, right? And you were talking more about homeowners, right?
Well, the industry as a whole.
Okay.
Because,
so what do you mean by tsunami?
Well, the tsunami is, you don't see it coming. It doesn't look, it's way far off.
Right.
And then all of a sudden it's so big you can't get away from it, right? I kind of feel like, in the years of experience that I've had in insurance, when I first came in to insurance, we were just learning about Hurricane Andrew.
Yeah.
And the, early 90s, late 80s, I can't remember exactly when that happened.
92.
Wow,
early 90s,
92, yeah. There were a lot of companies that just folded. They couldn't keep up with the cost to help people be made whole again. And what we learned from that scenario caused insurance policies to completely be rewritten. We're starting to see some things that can indicate that might happen again. And right now, even a restoration company shared with me, they've got policies that it's just a partial loss. Somebody just had a kitchen fire and they've already exhausted the entire policy. That's not good if that's happening in the industry right now.
Okay, so explain to... I'm sorry, go ahead, Eric.
Well, I think that was probably going to go the exact same place where you were going to go, because one of the things that sparked the conversation that we were having the other day was, what's the biggest topic in the financial services industry right now? I say financial services, and what's the biggest topic in the world right now is inflation. Yeah. The cost of literally everything is going up. We just had an inflation report that came out, a day ago, yesterday, 2 days ago.
2 days ago, yeah.
9.1% inflation year over year, the highest inflation we've seen since the 70s.
Yep.
It's bad. And that was kind of what triggered this tsunami talk about proper insurance coverage, because we think so much about inflation as it relates to food, gas prices, the things we think about every day. We don't think about inflation as it pertains to replacement of a house if it burns down.
No.
Car even replacement of part of the house because you have a partial fire.
Correct.
Or anything like that. And so if we're talking about, and one of the things that led to this was, you talk about you purchased a home 10 years ago. And you get coverage on the home based on the value of the home 10 years ago when you bought it. That home's not worth what it was 10 years ago. Even more so than that, the cost of replacing that home if something were to happen to it, or any other part of that home, is going to be astronomically higher than what your coverage is currently going to take care of.
Even before COVID, the inflation that's built into insurance policies is only like 3-4% to keep that cost of replacement up. And you have 25% on your policy, on a standard policy that has replacement cost, in the event there is inflation due to a catastrophe. The problem is COVID brought a whole countrywide catastrophe, and now anything that happens over that is kind of a double catastrophe happening all simultaneously. Then you add in inflation and the cost of materials being much higher. You add in people typically file claims more frequently when the economy is where we're at.
Right.
So carriers are going to have to, they're going to have to do something.
Okay, so let me pause you for a second. I want to go into that 25% rule because for those of you who are listening or watching that don't know this, I learn stuff from Heather almost on a daily basis. When she's not in the office out working stuff, I get mad at her because I'm not learning. And one of the things, I think Eric probably learned this too the other day, you were talking about that 25% rule. And I've heard you have this conversation with clients of mine, just like one of them was last night. People think that they have total replacement coverage. So you say to yourself, I don't need better insurance. I have total replacement. But as it turns out, that's not always true, and that's where that 25% rule. So explain what that means, how that is structured.
That is very good question, because there's two parts to replacement.
And we're talking homeowners now. We're not. This is not an auto issue, right?
Correct. It's not an auto issue.
Right.
It's definitely a homeowner's issue. They call it extended replacement cost, which means we're not going to depreciate the amount we pay you because your home is older. We're going to pay you what the new cost is, but you're still limited. So there's two parts to it. Yes, you have replacement costs. It means they're not going to depreciate that. But at the end of the day, per easy math, if your house is insured for $100,000, they're only going to pay $125,000, and that's it. They're done. If you go over that, you're going to have to find the cash, liquidate some assets, go to the bank, whatever you need to do in order to offset the difference. So that's why this is so critical where we are right now, because as to your point, a lot of people did get great deals on houses 10 years ago, even 7 years ago. And so a lot of people were slightly underinsured to start with. And then, the industry cannot keep up with that pace. So consumers are going to have to take charge of asking the questions, because agents aren't typically going to just call their customers and tell them, we need to increase your policy.
That's not a very fun conversation to have.
And if a customer, though, initiates the conversation, it's a much easier conversation for an agent to have with a client.
Well, something else you said struck me as well, where you were talking about in our current environment with inflation and the cost of goods and services being so astronomically high. More people are spending money on their everyday purchases. Yep. So when an event happens that they have to pay for something, normally there's always this battle, especially, I'm not even talking about a full home replacement. I'm just talking about, you're in your car and you ding someone, or you have a fender bender. You need to replace the bumper. Well, now you're probably weighing the opportunity costs or the benefits of filing an insurance claim and getting it paid for versus paying for it out of pocket. When money's a little bit stingier, they're going to pay more so. Instead of paying out of pocket themselves, they're going to file claims. So then you're basically creating a run on the insurance companies. Correct. And this is what happened for those, for a lot of the insurance companies, for anyone that wasn't around in this industry in 08, 09.
Right.
What happened in the industry, specifically the life insurance and annuity industry, was you had all of these annuity contracts that were extremely rich in benefits. And then when the market tanked, you had these guarantees. They were paying these guarantees out on a much higher rate. Well, when the market tanked, everyone said, you know what, I'm going to turn on my benefits at this level when the value was down here. And so that caused a lot of insurance companies to have to reprice the premiums and the benefits that they're putting on all of these annuity contracts. So to your point, that's you're seeing the same thing starting to happen now in the home and auto industry.
Well, and here's the thing. The reality is that actually is going to be a double. But that's part of the tsunami too, because what is happening is industry cannot keep up with the inflation. The only way, and the markets and bonds are where they actually make money, which we all know where that's at.
Right.
So the only thing they can do is take a rate increase or change underwriting. That's the only way that they can manage their profitability. And how do they do that? Well, if they take a rate increase, they can only take up to 25%. It has to be qualified by the state, and then it has to hit the consumer, and then they have to collect the premium. You're at least a minimal 3-year tail.
Okay.
Easy, right? In the meantime, what has to happen is they're going to start non-renewing clients with claims, that they can get off an account that they don't want to continue to pay on. And then the new customers coming in, they may just decide, we're not taking any new customers. Or we are, but you can't have any claims. So you're coming out of this market that people are going to be more susceptible to filing them. And then you turn around and you get canceled, and then you can't find insurance. So from the consumer's perspective, that can be a really dangerous place.
Well, you just made a comment as well, and I want to revisit it a little bit, because at the beginning of your comment, you said what insurance companies do with the premiums that they receive from consumers. What insurance companies do, and I was, I'm a survivor. I'm a survivor of being an employee at a large insurance company. So we talk about it all the time here internally, but I have the scars to prove it. But what insurance companies do, when you pay an insurance company a premium, what they do to try to make money on that premium is they invest typically in very low risk bonds or fixed income types of instruments.
Right.
We just did a podcast about this that aired last week, talking about the biggest problem in the markets right now. Obviously, the markets have not been great, and the equity side, and everyone talks about stocks, that gets all the attention. That's been brutal. What's been more brutal has been the fixed income side.
We've got no place to go with the stocks.
Because when you're trying to find a safe haven for what the equity market is doing over here, typically your bonds and your fixed income, that's your safe haven. It's going to zig when the equity markets are zagging. That's not happening. In a lot of cases, they're down just as much, or if not just as much, quite a bit. So you're seeing fixed income instruments down 10, 15% year to date. So insurance companies, once again, aren't making the kind of profit, aren't making the kind of returns on their safe reserves that they're having to hold. So going back to your point, how do they recoup that? They have to re-underwrite a lot of these policies.
They have to re-underwrite. That's the quickest way. The quickest way is re-underwriting, right? So that's going to happen faster than the rate increases. The rate increases, they already have projections, right? They have enough people that are brilliant and spend way too much time in tables and numbers that I don't care to ever be in.
Oh, yeah.
But they also...
Well, insurance companies are great at mitigating risk. They don't, to the point that they do not take risk. They know exactly the amount of risk that they're taking with every dollar that they allocate in an insurance contract. But to me, what I found so fascinating, what happened in our conversation the other day that prompted this episode, everything is full circle. We always talk about the economy, and it's always fascinating to me. This was an angle I had not even considered. I didn't even think about how this was going to affect property and casualty, because we kind of live in our own world. And
we do.
Especially this year, it's been, we're so focused on the investment side that and obviously you're focused on the insurance side, and we're not as focused on that. And it's always so interesting also when clients walk in the door that work for all these different industries. Right. And this has just been something I've kind of enjoyed over the last couple of years, how the economy as a whole is affecting your industry. How did COVID affect your industry? How does the supply chain issues affecting your industry? Because once we're so focused on this that we lose sight of what's happening out in the quote unquote real world, right? and this is how, it's just funny how everything is just sequential, right? Everything is a domino. You start with one little domino and it bleeds into a bigger one and a bigger one and a bigger one. And now you're seeing this economic collapse that's hitting the insurance, or going to be hitting the insurance industry.
Well, it's already hitting in Florida.
Yeah.
I mean, that's happening in Florida right now. The agents can't get coverage placed. I mean, it's an issue already. And to your point of how the trickle effect goes, it's not just homeowners. Businesses are going to be affected as well. Yeah. Your commercial insurance gets hit before usually personal lines. So it's going to hit both sides of it. So even your business owners they're already struggling with COVID. They're already struggling with retaining employees, all of these other things. It's just one more thorn that they're going to have to deal with.
And if you're in an environment where you're trying to figure out how to pay employees more to keep up with inflation, to keep them happy, at the same time on the other end you're getting hit with higher insurance premiums. This is why the economy and just the finance industry fascinates me so much, because everything is correlated. It's a big circle when you think about what happens over here eventually is going to affect something over here.
Yeah, absolutely.
So we've been kind of doom and glooming for a while now. This has not been a pleasant conversation. If you're listening to this, you're going,
this isn't sunshine and roses?
Yeah, this is not sunshine and roses.
Well,
so the question that I would have then is, okay, you know this is coming. You were talking about that 3-year tail. Well, that's the tsunami that's off on the horizon. And we can say, oh, well, when this happens, then things are going to change. And when the economy recovers this and after the election, we can say that all we want. 3 years is beyond all those things, right? And that's when we're going to see that tsunami. So we know that's coming. What can we do?
Well, you know, the buzz in insurance, a lot of agents, and you might have heard a lot about this from your war rooms, but, you know, agents used to really be down on 800 numbers and, you know, online purchasing and all this other. That's going to be even harder to do. The value of having an experienced agent is going to be more and more critical. Someone that can advise, not just price. And really that's becoming less and less available. More and more training and mentorship in the industry. Plus we're losing a workforce of agents because our market, people don't, very few people wake up in their youth and say, I want to be in insurance.
That's my dream job. I'm being an insurance agent.
Job, you know. I fell into it, and I'm for the underdog. I'm always there as an advocate for the client. I'm a little bit of a weird bird because I don't really care about how much I make. It's more about what's right for the right reasons.
Which is the reason you fit in real well with us.
But that's going to be the only thing that they're going to have to find somebody they can trust, be transparent with, and someone that has enough knowledge and expertise to really help them navigate through the next, I would say it's well more than 3 years.
Yeah. I'm just thinking about you as a contestant on The Bachelor. You're there for the right reasons.
So let's throw out some actual cases that we've had these discussions. These are mutual clients that we've worked with to kind of tell people the difference between dealing with an 800 number and dealing with an actual personal agent, which you know we are obviously big advocates of. And if I wasn't already, you've definitely sold me on that over the last, 6 years or so that we've been working together. Eric and I actually have a client that we've been working with that we looked at it and we saw some potential insurance problems. And Heather reviewed it for us, and there was a zero claim. Well, I don't remember the name, but it was, okay, the insurance company he was dealing with is a very reputable company. This is not a bad company. It's actually a very good one.
Everyone would know the name if we said it.
You would know the name if we said it. We're not going to do that. But you don't have an agent that you can walk into their office and say, Heather, I got a question.
Correct.
You call an 800 number, which means you get somebody different every time you call. So you know which one I'm talking about now, right? All right, so explain that whole zero claim thing and then what happened in this situation.
Right. So underwriting, first of all, technically you're supposed to report every claim to the carrier.
Right.
Now, agents can help you mitigate, meaning, is this something that's financially beneficial for me to file? Is it something I have to file? If there's injuries involved, it's no question you have to file.
Sure.
Right. But in property scenarios on homes, you know, what part of it's maintenance, what part of it is actually a claim. If you have an 800 number, the person that you talk to cannot answer your question without filing the claim.
Right.
So therefore, you get to the next person, they say it's not covered, and nothing's paid out. But there is a claim filed that's zero pay claim. This is going to be another part that's critical in this future because that is a claim. It is underwriting. It is on there. They spent dollars of staff to actually supply your answer to your question.
Right.
So even though they didn't pay out anything to you, so it's still a claim. However, when you go to underwrite, it can negatively impact whenever you're trying to price shop.
And that's what happened in this case.
Right.
The client had, it was a little fender bender. There were no injuries. It was a minor damage, right? Something that you might just take it to a body shop and pay cash and get it fixed. But because he called the insurance company and asked, they had to file it.
They had to file it.
And when they did that, even though no monies were paid out, when you actually looked at trying to improve his rates, there was a claim on there as if he had had a car accident.
Correct. So 2 things to that. It probably didn't impact his existing policy because
Right.
they aren't going to affect his rate for a zero pay claim on a current policy. But what it did do is lock out the opportunity to find savings with other companies.
Right.
So another example that happened through Hurricane Ike and the power outages all around Louisville, I won't say the company, but a good company just wrote out checks to customers for spoilage. Customers were super happy. They got
When you say spoilage, you mean like food spoilage, right?
food
Okay.
spoilage
All right.
because of all that. Customers were really happy. They got $500 or $250, I mean, just depending. Everybody was happy, right? Until their policy renewal came in, their increase, and then guess what? They're locked out from being able to find a better rate because they had a claim on their home. So again, you're going to have to start as a consumer paying attention to what the cost is really going to be.
Right.
And you're going to need somebody that can talk to you. If all you have is an 800 number, you're not going to get that value.
Well, you're not going to get advice by calling that 800 number. We talk about this a lot when clients are mulling whether or not they should be filing for Social Security.
Right.
If you call the Social Security office, they're going to answer your questions about, they're very technical questions if I file here or if I file there. But they're not going to give you advice on what you should do.
Right. They're going to tell you what you can do, but they're not licensed to tell you what you should do. Same
Could
thing
be the
applies.
case, depending on the 800 number. A lot of those people are not licensed.
Yeah.
They have to refer you out.
And I can't help but make the analogy here that you just made the analogy. You talk about, the law of unintended consequences, all of those people that were happy to get the small checks in the mail. And then when it came time, later on down the line, it ended up costing them money in their premiums.
Probably more money than what they received, at least over a period of
I
time.
just keep thinking back these stimulus checks that
Same thing.
everybody got a couple
I was
years
thinking the
ago.
same thing, yeah.
And now the unintended consequences, we have record high inflation. It's just everything's a circle. Everything comes full circle. So
Yeah.
So let's do a couple of other things. And this was, just some things that are happening in the insurance business. If I remember correctly, what actually prompted this conversation the other day was a story, and I believe it was out of Florida, where a certain company is going to have to pay out $5 million.
I don't know what state it was. Yeah, there's
Okay, it might not have been Florida. Why don't you tell that story? And it's okay. Let me forecast the story. It's sad that this happened.
Yes.
But the situation itself, we laughed.
Yeah.
Okay, I will admit that we laughed. It's one of those that you go, you're making this up, Heather. It can't be true.
I really wish I was, but it's not.
So. But the point of the story was that it does kind of forecast some things. So why don't you go ahead and tell that story?
So there's a carrier that has to pay $5 million. Well, it's still being pushed back.
Still litigating. Okay.
It's still litigating. It's been up a couple of levels. I think there's only one more level to go. Either way, the carrier has been told they have to pay the claim, but
it's the claim that is outside of anybody's thought process.
Well, from an attorney's point of view, it's very creative.
Yeah, I'll give them that. It is creative.
And from the client, I guess from the person that it was injured, it should be justified if that was the case. But the thing is, apparently they had consensual sex in a vehicle and a transmitted sexual disease from one adult to the other. And that actually is personal injury in a vehicle.
Because it happened in a car.
Because it happened
It's an
in a
injury
car.
like a car accident.
I missed this conversation, so I'm new to this actually.
Yeah.
Oh, you didn't hear this one?
I must
Oh,
have
my
came
gosh.
in late.
Oh,
Yeah.
wow. Yeah.
So
I'm very intrigued though.
Yeah. So it's personal injury in a car.
Yeah.
The person was worth enough that they had a $5 million limit. The carrier is going to have to pay it.
Yeah.
That is not your typical car insurance loss,
No.
right? I mean,
Oh, my gosh.
it's just not. And
You usually don't find that in the fine print. Yeah.
well, it's not in the fine print. That's the creative, attorney
Right.
coming and saying, "Hey, you got injured in a vehicle,
Right.
and that's your personal injury."
That's
Now,
awesome. Yeah.
the two sides to that. When we were talking about it, like you said, there's two sides to it. One, if judges and litigators can require carriers to do it, if he didn't have adequate coverage to cover his assets, then he could have lost his assets. because he would have judged that judgment would have been, because that's the way the limits work on your policy. If the judge is more than your limits and you have asset worth more than your limits, then they're going to make you liquidate your assets. So if you have assets to protect and you're not fully covered, things are just going to get more and more difficult for you in the litigation world, because they're going to find ways, and carriers have to pay it. They're going to make individuals pay it.
They're just going to add more and more fine print every time one of these things happen.
Exactly.
It's a great headline when it happens, but the end result is going to be more and more barriers around any claims that a consumer might want to file.
Right. But it also, to the point, when we talk to your clients, the whole thing is about protecting your assets, because you don't understand where these things can come from. Insurance guys can be called the bad guy all day long, but they're there to protect you and all your hard work that you've put into what you've built in your wealth, right? So the more you have, the more reason you need to really pay attention to your policy and have an agent that can help you with it.
So it kind of wrapping things up, so that you don't have to toot your own horn, I'm going to, right? And this is, okay, obviously I love Heather to death. I mean, she takes such great care of both myself and my clients. I love her. But
Agreed.
You need to be working with independent agents and not an 800 number.
Correct.
And let me give you a couple of examples that have happened just in the last week of why. I had a client come in that owns multiple rental properties. That's going to be their income stream when they go into retirement. And it's actually a good one. They've got a great plan. We're pretty rock solid on that. And then we looked at the insurance coverage, which when it was originally set up, was set up correctly.
Yeah.
But going back to that inflation
ago,
thing, he hasn't reviewed it.
These were properties he bought in 2008.
Yes, most of them are 10, 12 years old.
Yeah, it was the kind of mid-2000s.
Right.
Yeah. Right,
So he, because he wasn't upping that insurance and keeping it up, and what the replacement cost that he had was not total replacement cost. So there's some definitions are important. His insurance to get him properly covered went from about $7,000 a year to almost $13,000, right? So that's a big ouch moment. But now he knows that the coverage is actually there. Now we know that if we do have a catastrophic loss of one of his income sources, because that's what these are to him, he has the coverage and his life is not going to completely change in a negative way. So that was one, and that was where an independent agent can actually review that correctly. And the second one we had was last night. That's one of the most fun conversations you'll ever have. Client came in, once again, we're building a great portfolio and we're setting it all up. And then I go and I look at the insurance and go, uh-oh. They live in the second worst county in Kentucky for uninsured, underinsured motorists. And he works in the worst county. Okay? He's probably about as bad a situation as he can get for likelihood of being in an accident that's not his fault and there's no insurance there to pick it up. And his insurance did not cover what he needed, right? Didn't have an umbrella, which is an absolute, in my opinion. There's nobody that should not have an umbrella. If you don't know what it is, call Heather. She'll explain it. We went through all of that. Heather dramatically increased their coverage across the board. Both homeowners, they went from one of those replacement and 25% scenarios to a total guaranteed replacement because you got set up with the correct company for them.
Right, for them.
They were moving from a good one.
Yeah.
Their auto coverage went up to more than double what they have in some cases. Put an umbrella on top of that, and the look on her face when you were explaining this was, oh my goodness, how much is this going to cost me? And then Heather got to the premium and it was over $1,000 less per year because an independent agent, Heather in this case, shopped it correctly and knew what to look for and the right kind of coverage. So I'm going to sing your praises and that of independent agents everywhere. Please talk to somebody who knows what they're doing. Don't just call an 800 number trying to save a couple of bucks a premium. You could really harm yourself, and you might end up paying more anyway.
Well, that's also a very specific case. I've had numerous cases over the last couple of years where, the fees that we charge from a financial planning standpoint are basically covered by the savings when we review the property.
I've had that happen multiple times.
It is astounding to me. You talked about umbrella policies. How many people do not have umbrella policies?
Most of them.
Or how many people are already underinsured? Couple that with this tsunami that is coming. It's definitely something I think is really in everyone's best interest to look at. Just taking a few minutes really to look at doing a re-review of your homeowners and your auto insurance and seeing.
And not just to find a price. That's unfortunate, but we've put ourselves as an industry in this hole where price is everything. Name your own price, 15 minutes or less. All of these slogans, they're all well and good except for it's not helping anyone. It really isn't.
Yeah, the reality is the biggest threat to most financial plans that we put together is a lack of insurance coverage. If something bad happens, and that's what insurance is for, is in case something happens, So you need to be able to account for, those bad things that could potentially happen because you want to mitigate the risk of those things basically derailing your entire retirement.
And more is not always more.
Correct.
That's right. That's right. And to Eric's point, it's amazing to me the number of clients that we've worked with that the fees that they end up paying us are completely eliminated in some cases by the savings that they get in other areas with actually better insurance. And it props it up so that plan's not going to fail because of something bad happening. And by the way, folks, bad stuff happens to good people all the time.
Absolutely.
I'm driving down Hurstbourne Lane last night on my way home. About 15 cars with blue lights blocking the oncoming traffic. I don't know what was going on. That kind of stuff happens.
Every day.
Make sure that you're protected correctly. All right. Anything else we want to wrap up? I think this has been an interesting conversation, and I would say this would be my conclusion. We went into a lot of doom and gloom, and we talked about tsunami and under coverage. But you know what? All you've got to do is just get somebody to help you that gets you in the correct coverage, and you're taken care of.
That's right. Just find somebody you know and trust.
Amen. All right. I think that's all we've got for today. Thank you for joining in. I'm going to let Eric sign us off and make sure you just subscribe and all that stuff because I can't remember it.
Well, yeah, what Chris just said. Make sure you subscribe and stuff. Thanks for watching The Money Puzzle or listening on whatever device or podcast platform that you are currently enjoying our content on. Please feel free to share any of our content that you feel might be relevant to any friends or family that might benefit from anything that we have to say. We greatly appreciate it, and until next time.
The information given herein is taken from sources at IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal-related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources at IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal-related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.